Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full service financial firm here in Boulder, Colorado. I want to talk to you today about 2016, which was an interesting year, and 2017. So, before I start off, I do want to look at the big picture because if you've been watching my videos, if you listen to me and read my newsletters, etc., you know that I'm a big believer in the impact of our behavior on our long-term reaching of our goals. And the reason why I say that is stocks and bonds are inherently long-term investments, but yet we look at them. Sometimes we judge them on a short-term basis. I would also say the same thing we have a tendency as humans to do with the presidency. I mean, the presidency is really a short term. When you're looking at multiple decades, it's really short term of being 4 years or 8 years. And so I believe that we give too much credit and too much blame to whichever president happens to be in power. And just like, I happen to be a Denver Broncos fan, and hopefully you are as well. Let's not kid each other. We have an inherent bias thinking that the refs are against us, but the other team believes just as strongly that the refs are being fair or going against their team. And so we have to be aware of our particular biases. We have to be aware that we are invested in long-term investments of 5, 10, 20, 30, multiple decades, but we might be looking at kind of a microscope into a daily, a monthly, a quarterly, a yearly view of what's happening, and that's reinforced by the 24/7 news that we have. So we've got to be aware of this dynamic. Okay, I am going to put up on the screen there some of the 100% unmanaged stock market index, and I'm going to highlight with that red bar there what has happened over the last maybe 2 years or so. You can see that there were two declines of an not insignificant nature, double digits, and those were painful. And it is normal for those things to happen. I'm going to put another chart up there in just a second. But one thing that it has shown is that sometimes we have to be patient. When we're looking at multiple decades, it goes up, it goes down, and it goes sideways. And so when it's sideways, it's just waiting for it to make a movement one way or the other. And that's why you've got to look at things from a long-term point of view. Okay. This next chart you've seen probably every video that I've put together because I love it so much. Each one of those graphs, and this is going back to 1980, so that's a good 36 years. The red numbers at the bottom are the intra-year decline. So as an example, if the market went up 15% and then gave up 10% sometime during the year, that would be a negative 10% intra-year decline, just as an example. But one thing that has shown that the number at the top is that those intra-year declines are normal, but it doesn't mean that the year ends that way. And so one of the reasons why we have a balanced portfolio is to keep our emotions in check, to let us smooth out those particular rides. I'm going to put another chart up on the screen there. This is one of my favorites as well. You've seen this before, and then I'm going to get into 2016. The left-hand side, the green, the blue, and then kind of that murky brown. The left is a 100% stock market index, unmanaged. The middle is an unmanaged bond index, and then the third bar there is a 50-50 split. And then we've got those groupings of those bars from left to right. You'll see that it's a 1 year, 5-year, 10, and a 20-year time horizon. I'm just going to put a circle around what I think is most important, which is a mixture of stocks and bonds together, 50-50, historically going back to 1950, has actually never lost money, although it absolutely could in the future. That's really important to know, is that all we have to look at is the past, and it does not guarantee the future, but it's good for us to know what has happened in the past, so that if we have some unrealistic fear, we can say, why do we have that? Okay, once again, getting in control of our particular emotions. Now, when the stock market goes up, we say to ourselves, it's very human nature to do this, is to say, God, I should have had all my money in the stock market. Or when the stock market goes down, we second guess ourselves and say, gosh, why was I so aggressive? Why didn't I have it all in the money market? And then sometimes the bond market does really well. And we say, gosh, I should have had all my money in the bond market there. Why wasn't it in the bond market? And it is very dangerous to think that way. Very dangerous to, in my opinion, to try to be in the perfect place at the perfect time all the time. And it just doesn't work that way. Having a good balanced portfolio does help out because we don't know what the future is. And so we're trying to increase our probability of the desired outcome in the future while trying to maintain our particular plan. This next chart here, this is one of the worst times in the stock market in most of our lifetimes. This is if you had the absolute worst timing to buy in March of 2007, and you had a 100% stock market index, then it took you about 5 years to break even. If you had 60% stock and 40% bonds, it took you 3 years to break even. And if you had 40% bond and 60% stock, it took you 2 years. So if you had some kind of a balanced portfolio, 40, 60, 60, 40, something like that, one of the worst markets that we've seen when everything pretty much went down. I mean, I'm being generalizing, but I'm telling you, almost everything did. Your break even was 2 or 3 years when you have a multi-decade time horizon. I mean, we've got to be realistic in the investments that we have and our expectations going forward. Okay. Last year was interesting because the first quarter was very tough, very difficult. And then the second and third and fourth quarter, we kind of dragged ourselves out of that particular hole. I wish in hindsight that I had 100% of clients' money in the stock market in the fourth quarter. I mean, let's not kid each other. I wish that was the case, that we were super aggressive after that presidential election, which was a surprise for most people. Okay, most polls had Clinton winning. And we can sit here and talk about whether or not the polls were right or anything else. Doesn't matter. That's the status, is that most people thought that she was going to win. And then Trump won. And even when he won, most people said, oh my gosh, this is Armageddon. Paul Krugman, he's a famous New York Times columnist. He said it's never going to recover. Well, of course, famously wrong. It was one of the best quarters. Okay. What was frustrating is that the bonds in the fourth quarter really had, bonds in general, of course. Every time I talk, I'm talking in generalities here with the exceptions that are out there. Bonds had a really, really tough fourth quarter, and one that I believe is going to recover in 2017. So unfortunately, the gains that, if you had a balanced portfolio, that you would have seen had you only been in stocks in the fourth quarter, in general, were negated by some of the sharp downturn in the bonds in the fourth quarter, and that is absolutely frustrating. In general, the 2 quarters where, if you have a balanced portfolio that you made money, was the second or third quarter of last year. The 100% stock market indexes did make money last year, depending on which ones they were. They were even the high single digits, maybe even up to 10, 11%, depending on where you were. Bonds, very bad last year, but the balanced portfolios were in the single digits of last year. If you're looking at a unmanaged stock market index balanced with some kind of an unmanaged bond index as well. Okay. Let's talk about 2017. I actually am bullish both for stocks and for bonds. I believe that the downturn in the fourth quarter of 2016 in bonds was an overreaction. And they're going to, even with rising interest rates in 2017, it has been priced in, and that bonds are going to be a place that we should have some exposure. I think that equities are going to have some run up still, not because it has, it's necessarily going to continue with what they've got and the momentum, or some people are also saying that we're due for a correction. And yes, it has been a long bull run, excuse me, in general. However, I'm going to put, excuse me, I'm going to put a graph up on the screen, and we're going to see that that consumer confidence is very high right now. So if you, depending on, frankly, getting back to the political bias, if you are listening to some news outlets, all they're talking about is all this negativity. If you are on the other side, they're talking about how wonderful everything's going to be under a new President Trump. Well, the truth is probably someplace in between. I will tell you, though, that the consumer confidence in the stock market is very high. Now, we can't take that too far because this is usually a lagging indicator. Stock market goes up, then all of a sudden people are confident. Well, that's after the fact, not before the fact. As a matter of fact, some of the best times to buy is when consumer confidence is at its lowest. I put another graph up there on the screen. One of the reasons why I'm very bullish is I believe the percentage of cash that is on corporate balance sheets is a very exciting place to be. They're in a stronger position than they were in the 06, 07, 08. They've built up their fortress, and that is still to be deployed. Billions and billions of dollars ready to be into research and development and to weather any kind of a storm that we might have. Corporate profits, another graph that I've just put up there, are also at an all-time high, and this is a good thing. There is lots of liquidity out there in the market. I think that the confidence is out there, and we'll have to see how things unfold. But one of the graphs that I'd like to go back to is what's your conviction? I mean, what do you think 5, 10, 20, 25 years down the road? Do you think that are you bullish on the United States? And I would say on investment and the progress that we've made in the last 10, 20, 30 years. And do you believe that would continue going forward? I happen to believe that that's the case, and I want to be a part of that. And so therefore, one of my very first things that I have to do when looking at 2017 is to get my head in the right time horizon and say, yeah, I want to be a part of that. I've come to the conclusion, and this is a general view, that the more aggressive that you can be over many years, you're probably going to do better than a balanced portfolio, but the ride is very bumpy. And so it's a lot of it has to do with you and your emotions and what you can handle. And so only you can answer that, or we can answer it together. That is my 2016, my 2017 year-end, beginning of the year video. I'm always here to talk with you and to help you out as we reach your financial goals. Mike Brady, Generosity Wealth Management, 303-747-6455. Thank you for being my client. If you're not my client, you need to be. You're a pre-client. That's how I think of you. Have a great day. Bye-bye now.